When it comes to cash flow, growing too fast can be just as dangerous as not growing at all. 82% of small businesses actually fail due to cash flow problems, even ones that are experiencing success with their sales. So a lot of business owners think that increased sales actually means increased cash flow, and that's not quite true. What happens is as you increase your sales, if your cash flow can't keep up with those sales, you run into problems being able to pay vendors, pay your employees, definitely paying yourself. Let's talk about 5 ways to make sure that your growth doesn't outpace your cash flow. First, you want to understand your cash flow cycle. So what does that mean? You want to look at your accounts receivable and see how long does it take from the time that the sale is made until you actually collect payment. A lot of invoices or businesses will use something like a net 30 in order to collect on their invoices. And that means that you have to be able to sustain 30 days of cash flow without those invoices coming in. 2, you want to forecast your cash flow on a regular basis. And what we like to do is look at your cash flow over the course of 12 months. What are your busy seasons? What are the slow times? And being able to view that on a month-over-month basis will help you know when you need to stockpile cash and then when you are going to have slower times where you might be dipping into your reserves. Now, after you've looked at it on a 12-month basis, you want to look at it regularly on a 13-week rolling cash flow. And so that will be able to look at your income and your expenses on a much more detailed level, because you should have a pretty good idea of what revenue you have coming in as well as what expenses you might have over the next quarter. 3, you want to manage your expenses wisely. Now, a lot of business owners like to do things like invest in their business, and I'm not saying that that's not what you should do. However, you want to make sure that those investments into your business have a quick ROI if you're having cash flow issues. So you want to make sure that those expenses that you might be bringing in, if you are in a tight cash flow space, don't spend on things that have a really long ROI or are things that aren't actually an investment. You'll also want to make sure that if you're in a tight cash flow period, this is not the time to be doing a software implementation that maybe you don't need, or bringing on new staff at this point. You want to make sure that whatever you're doing, you have the cash flow to sustain. 4, you want to build a cash reserve. And a lot of these problems go away once you have some reserves. We like to see 3 to 6 months of your operating expenses in a savings account, and that will help you kind of sustain those slower times. But it also helps you get through, because when you're not in a cash flow bind, you don't have to do things like taking on a high interest loan to have cash flow, or you don't have to sell equipment and things like that will cause issues down the road when you need that equipment. 5, you want to speed up your receivables. There's a couple of things that you can do to make sure that you get your receivables in quicker. This ties in with number 1, but you can offer discounts on your invoices that are paid either same day or within net 10 or net 15. A lot of businesses will add maybe a 2% discount to their invoices for quick payment. You can also automate your invoices so that reminders are going out on a regular basis. And that way it's not just a single invoice that goes to the customer, they have regular reminders that are telling them they need to pay. So in business, cash flow is king, but in the next video, we'll talk about the billing process, which is actually the way that you can speed up your cash flow and make sure that you always have cash in the bank. See you there.